Hi, hello friends. Welcome everyone to Super 25, India's largest retail traders online conference. I am Ashok Devanampriya, the CEO of Traders Gurukul and also the host for your today's program. It's a great pleasure to invite every one of you to the third edition of Super 25. Before we kick off the program, I would like to thank our media partner Money Control Pro, the largest financial portal in India. I would also like to appreciate and thank our title sponsor Espresso from the family of Sher Khan, one of the leading stockbrokers in India with millions of investors as their customers. The speaker for today is Mr. Rakesh Pujara from Mumbai. He is going to empower us today with his special topic, the Holy Grail, diversification into non-correlated strategies. He is the founder and managing director of Compounding Wealth Advisors LLP. He has been in the financial market for more than 25 years. A commerce graduate from Mumbai University and an ICWA from the ICWA Institute. He had his experience in the finance domain from various industries like diamond, exports, and media industries. And in 1999, he joined Sri Naman Securities and he retired as the CEO of Naman Securities before he kicked off his organization, Compounding Wealth Advisors. Mr. Rakesh, I think you are speaking in our program for the very first time. It's a great honor to have you on board, sir. On behalf of Traders Gurukul, Money Control Pro, and Espresso, I extend my warm welcome into our program as an elite speaker. Go ahead, sir. The stage is yours.
Thank you so much, Ashokji, for your kind introduction, and welcome all the viewers and audience here. And the topic for today, as introduced by Mr. Ashok, is the Holy Grail, the diversification into non-correlated strategies. We are currently living in very interesting times, and this presentation could not have been timed accurate than what it is today because everybody knows the kind of volatility that we are going through internationally and locally also. Different asset class moving differently, and all the correlations are almost kind of going for a toss. And this is where this kind of approach of diversifying into non-correlated strategy would help us navigate this turbulent time. Currently, everybody is aware, lot of inflation worldwide. There is a war going on between Russia and Ukraine, and in this kind of environment, Fed is tightening and raising interest rate. We had our fair share of rise of interest rate in a unscheduled meeting by RBI 15 days back, and that has created so much turbulence in the market. And inflation and everything worldwide is like around 30-40 year high, and that is causing a lot of turbulence in the market. Suddenly gap up and gap down, and the next day gap up and the next day gap down, and we're getting used to kind of gaps every on a day-to-day basis. And how to survive in this kind of market and how to navigate this, that is the topic of the today. I'm of course, Holy Grail is not used very in a positive connotation in our community, but I am going to use that word as a very positive connotation. And the Holy Grail of investment and trading is going to be diversifying into non-correlated strategies. And I'm going to demonstrate how diversifying into non-correlated strategies helps us improve our risk-adjusted returns. And my introduction already given by Mr. Ashokji, so I'll not spend much time on this. And I'm SEBI registered advisor, and I'm into system and algorithm based trading. And I've started experimenting with algorithm trading in 2012-13 when I was at Naman Securities as a CEO. And 1st January 2018, where I founded my company called Compounding Wealth Advisor with an objective of doing 100% rule-based, system-based trading based on algorithms. And this world of algorithms and system trading inspires me, and it amazes me every day, developing new systems and trading on a regular basis, adding few systems, removing first few systems based on the performance and all that. And I can't be more fascinated by what I'm doing currently. And this is the journey I have embarked from 2012-13. It's almost I've completed 10 years, and I'm still a student of what I'm doing. And uh, I hope to learn more in the times to come and deliver the better risk-adjusted return for ourselves and for some of our clients where we give consultancy. And that's about it. And I'll take the presentation. This presentation is basically inspired by two of the greatest hedge fund managers. First of all, Mr. Jim Simons from Renaissance Technology, and second is Mr. Ray Dalio from Bridgewater Associates. These two gentlemen have demonstrated their ability to generate returns irrespective of market situations, whether markets are up or down or sideways, and they've been able to do it consistently over a period of 3-4 decades, and that has kind of raised curiosity in my mind. What is this guy doing differently than what other people are doing? They generally are not having negative years, and every year they generate a very supernormal return, particularly Jim Simons. And of course, Ray Dalio also generates a very good return, but the return profile of James Simons in his medallion fund is unheard of, can be unmatched, and still going great guns at this age. And that raised a lot of curiosity in my mind. So I deep dived into what they are doing and how they are doing and all that. And whatever currently I'm doing at my compounding wealth advisor as a company is inspired by more by Mr. Jim Simons, and uh, I try and replicate the thought process, particularly how to generate greater risk-adjusted return for the clients. My sources for this is The Man Who Sold the Market by Gregory Zuckerman and the book called Principles by Ray Dalio. Then there are a couple of articles on a public domain where I have taken a lot of inputs from. And thank you for all these gentlemen for sharing their insight. And today's presentation would not have been possible if they had not uh, agreed to share their experience via book and articles and all that. So we are indebted to all these gentlemen. So what is the Holy Grail? Holy Grail of investment and trading. So this is the slide where I'll be spending some time understanding. I have spent a lot of time understanding it, and I would want you guys also to look at the slides and spend some time on this. What it essentially tells is this x-axis is number of assets in the portfolio. This y-axis is annual portfolio standard deviation. That is what it is. And what it essentially tells is as you increase number of assets in a portfolio, the standard deviation of the portfolio goes down. That is the concept. So this chart shows, suppose you have one asset and you have 10% standard deviation. And as you increase assets from 1 to 2 to 3 to 4 to 5 to 6, and if assets are 60% correlated with each other, so 60% of the time they move in tandem when in terms of return they generate on a daily basis. So that is what 0.6 correlation denotes. And if they're correlated 0.6% of 0.60 correlation is there, then you can reduce the risk, that is standard deviation of portfolio, by 15% and not more. What it tells me that if you are lesser correlated, for example, if you are lesser correlated, say 0.4, 40% is your correlation, you're able to reduce the risk more. Like 10%, you are able to reduce your to 8.5%. But if you're only 40% correlated, if the assets are 40% correlated with each other, you're able to reduce the risk from 10% to 7%. Likewise, if the assets are 20% correlated, you can reduce the risk further. And if you add 20 assets which are non-correlated with each other, so asset number 1, 2, 3, 4, 5, 6, and the condition is there has to be zero correlation amongst the asset in terms of the return they generate on a daily basis, and number has to be 20. then almost you can reduce the 10% standard deviation of portfolio to 2%. So you can reduce the risk by 80%. That is what the message is, and this is a very, very powerful slide, and this will set the backdrop of what we do and what we recommend people to do. If this is a slide worth spending time on to understand, assimilate, and kind of implement in your daily life while doing trading and investments. And as I told you, if you diversify, your risk is always reduced. That is, everybody knows. But what we don't know, if you are correlated 0.6, even if you diversify, say out of say 20 stock, 20 assets, you go to 50 assets, or maybe 1,000 assets, then also you will not be able to reduce risk much beyond 15%. So the correlation matters a lot. If you are 0.6% correlated, even if you add thousand stocks in your portfolio, you can reduce your risk only 15% and not more. So if you have to reduce your risk further, you have to look for assets and income stream or a return stream or a strategy generating return on a daily basis which are less than 0.6% correlated. If they are zero correlation, that is the best. And if you have 20 assets, your risk reduced to almost like by 80%. And the right hand side, what it shows is, suppose you have one asset and you have a risk to return ratio of 0.25. So when I say risk to return ratio, say for example, you have a return of 5 and you have a risk of say 20. So your risk to return will be 0.25. And if you have this kind of return, risk to return portfolio, the probability of losing money in a given year is 40%. As you add more asset, your return to risk ratio improves from 0.25 to 0.28 to 0.31, and probability of a losing year reduces. As you add 20 assets in your portfolio, your return to risk will go as high as 2.5. So it improves from 0.25 to 2.5. That is almost 10x improvement. And probability of a losing year reduces to almost 1%. So this is the crux of what I'm going to talk today. And this is what great hedge fund managers like Ray Dalio and Jim Simons and many other people are doing in the world. And that sets the backdrop of today's presentation. Please remember, this is a very important slide. This slide has been taken from the book Principles by Ray Dalio. It's a wonderful book, and one must read not only once, but a number of times to assimilate everything. So let us take a random assets, and this is just Monte Carlo simulation of a single asset. And we are talking of, when we are talking of risk in trading and investment, we are talking always of maximum drawdown. How asset goes through a maximum drawdown. And if you have only one asset, and if you run Monte Carlo simulation, for example, 95% of the maximum drawdown are less than 19%. If you have only one asset, this is some random asset and some random calculations, and Monte Carlo simulation on 1,000 path that is showing this result. But the moment you increase the assets to 100, the 19% drawdown goes to 2%. This is the power of diversifying into non-correlated assets. One asset, you can have 19% drawdown, 95% of the maximum drawdown will be within 19%. The moment you increase it to 100, the drawdown reduces to 20%. So 95% of the maximum drawdowns are less than 2%. Now, let's say if you increase the assets to 10,000, almost you have a nil drawdown. Like 0.10% is not even a drawdown. So this is the power of diversification we are talking, and this is what helps you weather the kind of environment that we are going through. Suppose you are just trading in a crypto market, for example, then you are only long only in crypto. and you are not playing the short side of it, then you are in trouble. But suppose you are playing short side of it, so that creates another strategies. So probably you will be in a huge profit today. But suppose you are long short both, and short side is not making money for like a couple of years, and you give up on long shorts and you just run long only, then you are in for a greater drawdown. And uh, like Nasdaq has been on the up run since last 8, 9, 10 years, and now suddenly it is down by 30%. So when you run only one strategy, or when you trade only one or invest in one asset class, and this is the risk that we go through, the risk of a deeper drawdown and risk of capital ruin and all that exists, because whatever said and done, to withstand a drawdown of 35, 40, 50, 60% is very difficult, and very few of us can do it, very minuscule percentage of the people. That is why there are very measurable number of people who are a long-term investor and who holds through thick and thin of the markets and make returns like how Warren Buffett is doing and all. But not everybody of us can do that. That is why there is a need for us to diversify, and that is why uncorrelated strategies and uncorrelated assets makes a real play a vital role in what we are going to do. See, the above slides demonstrated the impact of trading a large number of uncorrelated assets on a portfolio volatility. And you've seen how the drawdown, which was like 19%, and how it reduced to 2% and 0.10% if you increase the number of assets to 110,000. See, one important aspect which I read in the book, Mr. Zuckerberg mentioned in the book, that Renaissance may have, say, 4,000 stocks long and 4,000 short stocks at any point of time. And taking maximum trades on such a massive number of assets has a profound impact on the portfolio of risk and drawdown. So when you are, say, long on short on 4,000 stocks, and you're long and short on 4,000 stocks, that gives you the kind of diversification, and it improves your risk adjusted returns, and it ensures that your year is generally not negative. And this is the kind of diversification that this hedge fund are doing, particularly in Medallion Fund, and that is why the exemplary. I'll show their track record also in the slides to come, how they have, what kind of return they have generated, and it's not like 1 year, 2 year record, it's like 30, 35-year record they are having. This is again very powerful slide. This is the cone. This is cone chart of Bridgewater by Ray Dalio. Okay, what it shows is the center line. Center line is the expected rate of return projected in future. Okay, right from starting from 1991. So I'll explain you the next slide how they do it, and what it signifies. The the thin line, pink line, is a projected expected return. The black dotted line is the actual return since 1991. So you are talking almost 30, 35 years of track record, 20, 25 years of track record by Ray Dalio. And this is one standard deviation of return. This is one standard deviation on the upside. This is one standard deviation on the downside. This is two standard deviation on upside, and this is two standard deviation on downside. And they call it a cone chart because it has an appearance of a cone. And in his book called Principle, he has explained this. Okay? Way back in 1991, when they started Pure Alpha, they decided what kind of strategy they are going to follow, and they projected the return for the next 10 years. Okay, what kind of return we are expecting, and they compared with the actual return they achieved during that period of time. What they are saying is advocating to their client also. Okay, suppose we have projected this rate of return, and suppose we cross that on the downside beyond two standard deviation, you should immediately withdraw your fund. That means something we are not doing what should be done, and this is the level of confidence this guy have in what they are doing. And The reason is they are diversified so much into uncorrelated assets that you look at this black line, the actual return is well within one standard deviation of return, and it is oscillating around the line expected rate of return. And they have projected this in future as well. What kind of return they are expecting and all that. This is cumulative return, and this is what the line looks like so far. Like since inception, they have generated so much return on a cumulative basis, and this is what they are expecting. And what they're claiming is they will be within one standard deviation and at best two standard deviation, and they would never cross this two standard deviation. That is what they want, and that is what their hypothesis is. And the reason why they are so confident, like even back in 1990, they had projected for the next 10 years, and now we are seeing the live track record of 5 years. And the very reason they are able to do is because they are diversified into non-correlated strategies. And this is again a very powerful slide that one should look at, and one should try and follow this kind of eternal principles for in our trading life also. Like for example, when I say assets, it does not necessarily mean that you are trading crude and you are trading gold and you are trading indices future. In our daily life, we can even we can diversify into various option strategies also. We can diversify into long short strategies. We can diversify into long short and long only, and we can have a strategy diversification. So when I say asset diversification, it includes strategy diversification. If you diversify your strategies, your return also improves, and you are able to use the leverage to enhance the return, and you're able to control risk. So far we have seen how this slide sets the backdrop of what we are doing. If we diversify into 20 non-correlated assets, we are able to reduce the risk by 80%. That is risk measured by annual standard deviation of portfolio, and it reduces the probability of losing here by almost, it goes to 1% from 40%, and return to risk ratio improve from 2.25 to 2 just by diversifying into 20 non-correlated assets. And this is what happens if you are just trading one asset. Your maximum drawdown, for example, if it goes to 19%, 95% of drawdown, Monte Carlo simulation. But if you trade 100 assets, your drawdown goes as low as 2%. And if you this is for the benefit of the audience who have joined now, that is why I'm repeating, so bear with me for a while. And if you trade 10,000 assets, your drawdown is almost reduced to 0.10. This is the Quant chart of Bridgewater, and this is the expected return, and this is the actual cumulative return, and see how they are well within one standard deviation of return, and that is they're able to achieve. They are able to achieve because they are diversified into non-correlated assets. So let us look at Mr. Jim Simon's Medallion Fund historical returns, and in our Twitter world and trading world, and particularly when somebody posts high return kind of strategies, and they are actually mocked. They are mocked, and people don't believe that these kind of returns are possible. But now look at we are a developing market, but look at what they've generated in developed world. Okay, right from 1988, what Jim Simons has been able to deliver in their Medallion Fund since 1988. They started this fund in 1988. First 2 years were absolutely mediocre. Their fees levels are too high, like they charge 5% management fees and 20% performance fees. Currently, they are charging 5% management fees and 44% performance fees. So this is the kind of fees they charge. And look at the returns they have generated after 1989. 55, 39, 33, 39. This is net returns. Look at the gross returns. Returns before fees. So they never had a negative year in last 30 years. Never single year is not negative. And initially they had a very moderate return. and a very limited AUM. The AUM started swelling with the returns. Look at the returns they started generating after that. 1990, 77, 54, 47. And see the consistency with which they are generating returns before fees. So even after charging performance fees of 20% and later on 44% and charging fixed fees as 5%, they're able to generate supernormal return. And this is the summary of returns of last 30 years. Gross return on an annual basis 66.1%. And this is done in international market, developed market like US. And net of fees and performance 39%. Never had a single negative year. And look at the kind of asset they are managing, $10 billion. Okay. So it's not that it is done on some a few lakh rupees as done by some small time trader, like when they generate 50-60%, people mock them like, it's possible only with 10 lakhs. And if you have a larger capital, you can't generate this kind of return. But see, we must keep our eyes and ears open, keep all the possibilities open, like this kind of returns are possible to generate. And the reason why this kind of returns are possible to generate, I'll show you why this kind of returns are possible to generate and how can we have a positive year every year. So that I demonstrated earlier only. If you diversify into enough number of assets which are non-correlated, the probability of losing year will go to zero. What happened after 2000? This is the return profile till 2018. Let us see what happened after 2018. In 2019, they generated around 39%. 2020, they generated, 2020 is the outlier, black swan event, like pandemic struck and everybody was, in this kind of year, they are able to generate 76%. I'm sure 2021 data is not available publicly, so I could not figure out what kind of return they have generated. But I'm very sure they must have generated positive returns, at least upwards of 40-50%, if not 76%. And this is generated on a size of $10 billion. So you are talking around almost 80,000 crore in Indian rupees. So how these kind of returns are possible? 66%. Say, for example, Nifty last in 8, 9 years, 10 years, 15 years, if you take an average return, Nifty might have generated 9, 10, 11%. Provided for every rupee invested, you are just taking position of 1 rupee. But what if you take a leverage? Suppose you take a leverage of 2 times, then probably that 10% goes to 20%. So the leverage is a profound impact on returns. But at the same time, when you take a leverage, as everybody knows, leverage is a double-edged sword. So as your return goes up, your drawdown also goes up, right? So everybody is aware about that, how leverage is a double-edged sword. But what if you're able to control risk through some measures and increase leverage? So that will give you the kind of return you expect, and that will control the risk as well. So this is an illustration of a return stream of 0.015% per day annualized for 30 years. With no leverage, the compounded annual return is 4%. That is what the dark black line is, this one. Second, if you're able to take a leverage, 5x leverage, then this is the return. And if you're able to do the leverage of 12.5 times, so you're able to generate an annual return of 60%. So it is estimated that medallion fund must have been leveraged at least 12, 13 times. So this is the kind of leverage that is available in US. Probably Indian market does not, Indian future market does not provide that kind of return. But of course, option market has a provision of, suppose you do a risk defined strategy, you can leverage 12 times. And suppose you do option buying strategies, you have 30, 35 times leverage available. So idea is to make a use of leverage, but keeping risk under control. That is what the idea is, and I'll show you how that can be done going forward. And if there's a feedback mechanism, are people following what I'm saying? Yes, no, or maybe something, or Ashokji, is there a mechanism of am I going slow, fast?
We are good so far, sir. Go ahead.
Go ahead. Okay. Thanks. So what we have done is we have derived some key statistics from 2013. What is the Nifty buy and hold returns and drawdowns since 2013? So 2013 has been taken as random data points where most intraday data is also available. So say 2013 to say March 2020, almost 10 years. And if you are just doing Nifty buy and hold, for example, you are able to generate an average annual return of 12%. Okay. It includes the current rise also in 2021, 2020 also, 2019 also. So you are able to generate, say, for example, 12% per annum. And every year, so I hope everybody knows what a drawdown is. So suppose you have 100 rupees and you start investing and your 100 rupees becomes 90, that is 10% drawdown. But suppose that 100 becomes 120 and then goes to 110, that also is a 10 rupee drawdown. So drawdown is either underwater equity or peak to trough, whichever is higher, maximum drawdown. And this is how a drawdown is calculated for every year. So for generating 6% return, you have seen a drawdown of 15. You have 31% and drawdown of 8.86. Here negative return, drawdown of 17. So on an average, every year you draw down 15, 16, 17%. In a year like 2020, you draw down 39%. So if you're following buy and hold, suppose you are able to generate 12% and you have a drawdown of 39%. This is the kind of drawdown that one goes through if people buy and hold, say, Nifty ETF. And it is supposed to be, it is marketed as a very safe instrument like ETF में पैसा लगाओ and you are kind of very safe and keep on buying ETF all the time. This is the return to risk profile. So it's almost what you can say 0.3 is the ratio, return to risk. So when I say risk, is 39% is the risk, okay? That is the risk of drawdown, and 12% is the average annual return. So when you divide this by this, the ratio will come around 0.25. Let us say if you're just investing in indices in some market like Japan, and you end up investing in market like Japan in say 1989, and 32 years have passed, and still your Nikkei is not reached the all-time high, and your annual CAGR is minus 1%. So see, ETFs and everything are sold as if they are the holy grail of investment, and people doing ETF are like will make a safe money. It's not like that. A country can go through this kind of, even Dow Jones has gone in this kind of patches in past like 20, 30 years without return, sometimes 10 years without return. So when long-term investing is preached, sometimes this long-term can become really, really long-term if you end up at the wrong end of the cycle investing. And suppose you make an argument that okay, ETF, we don't do ETF, but we are a smart stock picker, and we give our money to smart money manager, for example. So we analyze the best 10 performing stocks in last 10 years. So these are some familiar names. These are some marquee names people will swear by. These are blue chip stocks. And suppose you are a good marquee stock picker or a good portfolio manager, and suppose you end up picking only winners like Wipro and Bajaj Finance and Bharti Tele and Eicher Motors, then what is your return? Then your return is average annual return of 28% in last 20. So you have to be amongst the best of the best to generate this kind of return. But see what kind of drawdown you are going through. 45%. In 2020, you've gone through 40. Even if you are a marquee fund manager or a great stock picker, you have to have this kind of drawdown if you are just following buy and hold strategies. Even if you are a smart stock picker and a good fund manager that many claim to be, then also the ratio is 28% divided by 0.45%. So let us let us see mutual fund sahi hai ki nahi hai. So these are some of the equity mutual funds. These are the best performing. So I have not taken data of the say 80% of mutual fund actually do not outperform their benchmark also. So I've assumed that you are a smart mutual fund picker and you will pick up the best ones, and you know beforehand that which are the best mutual fund, and these are the mutual fund that have performed in past. We have taken data. So mutual fund has generated in last 10 years the best. These are the best of the mutual funds, okay, managed by the marquee fund managers, 18% per annum average. Again, the drawdown is 34%. So let us compare each system. Okay. So Nifty buy and hold, we show that 12% return with a drawdown of 39%. That gives us a Kalmar ratio. So I'll just give you a brief background of what Kalmar ratio is. Kalmar ratio is basically average annual return divided by maximum drawdown incurred during the period we are covering. Okay. So in this case, 12% divided by 39%, the ratio is 0.31. And I suppose you are a smart portfolio manager or a smart stock picker. This is what your return is, and this is the pain that you go through during that period. Your ratio is 0.62. And suppose you go through a so-called safe route of mutual fund. This is your return, 18.35, and this is your maximum drawdown. Of course, decent return. This is also decent return. That is also not bad. But let us compare with something derived out of quantitative investment algorithm. So this is our algorithm statistics long only algorithm called MILT. We call it momentum investment long term, and average annual return during the same period is 27%, and the drawdown is 41%. So this is a weekend system. So every week we look at the system and see what kind of portfolio that we have, and if there are any stop loss or do we have to add some position or reduce some position. There is a provision of pyramiding also here. So this is once you develop this kind of system, it is like one click at 3 o'clock Friday. Uh, you just run the code and see what are the signals and what are the buy signals, what are the sell signals, and such a simple thing. If you have idea about how to develop algorithm, investment algorithm, and see the returns you generate, it is next to the best of the best people can give. See the drawdown is lesser than what the best people can give. The ratio is amongst the best. All three. It is idea is when you do something rule driven, when you do something on a disciplined basis with some sort of a position sizing and some sort of logic behind, it is possible to beat best of the best people. And just following only buy and hold. This is again buy and hold algorithm. So there is no provision of short or something like that. So for me, buy and hold is not a good idea. Why it is not a good idea? Because in none of the cases, including the investment algorithm based system, ratio is above 1. Everywhere the ratio is 0.31, 0.62, 0.54, 0.65. Of course, the return is 27% is good, but again, you have to go to 41% kind of drawdown. I think this we went to this kind of drawdown in 2018 and 19, and in the first 3 months of 2020. Later on, it covered and gave a very good return in 2020, right? So we have compared this ETF buy and hold, portfolio buy and hold, system-based investing. This is our algorithm, and mutual fund buy and hold. We have compared that. But see, we have this beautiful system of indices future and stock futures. So there is no compulsion that you have to compulsorily buy and hold. Okay. Suppose this is the statistics of the algorithm I was mentioning, long only algorithm. Suppose you do long short both. This is long short futures, single strategy. We call it this is the name that we give to our strategy, Infinity Milt. This is Infinity Long Short Futures. The difference between these two is this is long only and this is long short. Okay. The return it generates is 27% per annum, and the similar backtested return for a similar period is 24% per annum. This is single strategy without any leverage. There is no leverage involved here. But look at the drawdown. Drawdown is only 12% here, and drawdown is 41% here. So your Kalmar ratio, which was 0.65, has improved to 1.96. That is the benefit of just adding one more concept. Like here, you were having only long only investment, and here you are going long short as well. This is the algorithm which tracks around 60 stock futures and goes long and short based on some calculation that we have in our code, and it immediately improved the ratio from 0.65 to 1.5. Now some people will argue like there is a 27% return and there is a 24% return. So why this is not better? I tell you why this is not better. Because to generate this kind of return, you have to go through the pain of 41%. Whereas generating 24% here, you just go through a pain of 12%. So return per unit of stress is very, very good here, risk adjusted return. And suppose you apply some sort of leverage here, which I'll demonstrate in the next slide, then it is possible to improve this kind of return. So again, we are not here at a multi-strategy. We are only is a single strategy. It is single buy and hold strategy. Again, this is a single long short future strategy. Now let us migrate to say multi-strategy. Okay. So this is infinity long infinity. This is not MILT, of course. This is infinity LSF. I think there is a mistake here. And it has got 24% return and 12% drawdown. Okay. Now, from single strategy, we migrated to multi-strategy. This is infinity indices algorithm that we have. These are all live systems. So mind well, these are not hypothetical exercises that we are going through. All the systems are live currently in our book, and we trade these systems. So this infinity indices is a combination of 125 patterns that we trade as a single strategy. Okay. So we scan through around 125 patterns on a daily basis. This is day-to-day basis. On a day end, we run this algorithm and go long and short based on this. And average annual return that is showing is 16%, and drawdown it is showing is 5%. Okay. See the ratio. The moment you introduce, instead of one setup, you introduce multi setups. So multi setups, when you introduce multi setups, basically you're diversified into 125 strategies within one strategy. And these strategies are again non-correlated with each other. The moment you do that, your risk adjusted return, Kalmar ratio improves. Okay. Argument again can be your return is 24. Why you should accept a return of 16? I'll explain in the next slide how we can improve this return, keeping pain constant. Suppose you take this 12% as a pain, and suppose your unlevered return is 16.777, and the pain in this system is say 4.73. If you accept this 12% pain, which is there in long short futures, okay, what would be your return in this system? Since indices can be traded in futures, you can go and do the leverage, like you can do margin trading. By deploying 1 rupee margin, you can actually take an exposure of 5 rupees in indices future. Or suppose this 12% risk is acceptable to you. What is the return that can be generated here? So if 12% return is acceptable, your current risk is 4.73. So you can actually do a leverage of 2.6 times. That will basically 12.27 divided by 4.73, that will give you 2.6. And this is the leverage. If you deploy here on indices, your return can be 43%. And your Kalmar ratio will be 3.55, which is again a very good ratio. to have, and your return immediately bumps up to 43. This is how one should use leverage. And leverage, of course, is a double-edged sword, and one has to be really, really do a sensible allocation, a part of the capital for leverage, and some part has to be, of course, parked into risk-free and all that. So this is how leverage can be used to your advantage. When uh, multi-systems like this are employed, and uh, you can actually do the leverage, then you can generate this kind of returns, keeping Kalmar ratio constant or 3.55, right? So that is what it is, and uh, this is what we do at Compounding Wealth Advisors, walking the talk at CWA. We have this product called Infinity Mona Lisa, and the capital deployed for this product is 8 crores margin. So we are leveraged almost 3 to 4 times. This is the statistics, backtested statistic that we have: 78% return possible to generate because of the leverage, of course, and it has never had a negative year in the backtested period at least. And current live is also showing like on the similar lines, and it is leveraged 5 times. Okay, and the product is live since 15th January 2021, and it is the beauty of this product is it is completely risk defined. Okay, when I say the risk defined, is like whatever exposure we are running, it's a directional system. So whatever direction we are running, either long or short, we completely hedge with at the money options. So it is completely risk defined and a VAR defined product, and it is showing a return of 78.6%, and with a with a maximum drawdown on a close to close monthly basis drawdown of 5%. So your average annual return to maturity becomes 16, and that is the kind of uh, risk reward that we are able to generate simply by diversifying into various known correlated strategies. This is the backtested report, and this is the key statistics. Mona Lisa backtested monthly returns stable from 13th January 2013 to August 2021. Number of negative months, only eight negative months. So more than 95% of the months are positive. There are no negative quarters, no negative 6 months. Number of negative years, zero. The standard deviation of return is 40%. 40% is really, really high, but some of it is because we have generated better than average return. Like for example, 2020, we have generated better than average annual return. That is why the standard deviation goes high. If it is around your mean return is 78, and your 1 year return is 185, so your standard deviation definitely goes higher. Okay, but suppose you remove this outlier here, 185% return, suppose you remove, then what is your standard deviation? We have removed this just because this is a standard deviation on the upside, right? So that's okay if you remove this. If it is on the downside, we have to accept it. But if it is on the upside, we there is a measure called Sortino ratio also. If you want to really measure, because what you are doing is you are getting punished for generating higher return. The moment somebody sees a standard deviation 40, their eyebrows are raised. Like it is beyond somebody's appetite to have this kind of deviation. But this deviation is on the upside. And suppose you remove this outlier here, your standard deviation is 15.9%. Your otherwise Sharpe ratio is 1.79. Sharpe ratio without outlier return of 2020 is 3.82. So this is the statistics of a product that we run at Compounding Wealth Advisors, and it requires a capital of 8 crore, and we can leverage up to 4 to 5 times. And the reason we are able to generate almost every year positive and a very decent return is this. This is the key. So Mona Lisa, Infinity Mona Lisa as a product has 9 strategies. Okay, so we have named it as strategy 1, 2, 3, 4, 5, 6, 7, 8, and 9. Each strategy is allocated certain capital, and this capital is, of course, I have arrived at allocation of this capital on an intuitive basis. but you can actually run efficient market portfolio algorithms to arrive at what kind of allocation can be made to this kind of strategies, and arrive at optimal allocation to each strategies. And see, let us see what is this correlation. Correlation is basically when you have a daily return stream or a monthly return stream. Suppose you do a correlation test of that stream. This is what the figure comes, 0.31, 0.5, and this is what the correlation is. So strategy one is correlated with strategy one at one, right? Each one is correlated with itself is one. It is correlated 0.31 time, 0.31 to strategy 2, zero point 0.5, zero point 0.4, 0.25, 0.39, 0.5, and this is negatively correlated to strategy 8 and positively correlated to strategy 9. Since all the correlations are below 0.5, if you combine all this, you're able to reduce drawdown. Since each strategy has a positive expectancy and each strategy is leveraged, you're able to generate a decent return. And since they are not, the returns, monthly returns, correlations are not correlated with each other greater than 0.5 or a 0.3 or a 0.39, or in some case negative correlations, you are able to control drawdown and reduce risk to a greater extent. This matrix for us is going to expand. We are every year, like we have at least 1 year of research pipeline at our organization where we are adding strategies, and that is why the capital requirement is going high and high and high. We started with 50 lakhs, then 1 crore and 3 crore and 5 crore and 8 crore, and soon like we'll be adding another 2 to 5 crore worth of strategies. So your mother product, which is currently 8 crore, will become either 10 crore or 15 crore in the next 3 to 6 months. So the idea behind adding strategies is just to control risk. Return is there in all the strategies, and you're able to generate return because of leverage. But to control risk, we have to diversify, and to diversify, we have to add more strategies, more concept, more ideas. Like you can have a trend following, you can have a mean reversion, you can do the pattern trading, you can do intraday, you can have non-directional options, you can have directional options, or n number of combination. You can go to other markets like commodity markets, you can go to other markets like currency market, you can go international, you can trade international indices. This is how you can keep on adding the strategies, and this is the road to creating a hedge fund of your own, and deliver the kind of return that probably Ray Dalio or maybe Jim Simon has been generating since so many years. So I hope people are able to assimilate this. And of course, if somebody has a question or something, we'll take it in Q&A section. And this is the live performance of Mona Lisa since January 2021. So we started with initially we used to run single strategy long short futures. For the first 3 years, we run that, so we generated around 83% there in 2018 and 13. But there was a huge drawdown in those strategies because the single strategies, you go through 30, 40, 50% kind of drawdown, and not everybody has that kind of appetite, including ourselves. So we started developing multi strategies, and from 1 crore capital, we introduced 3 crore capital, and then we added another 2 crore strategies and another 2 crore strategies and one more 1 crore strategies and all that. So current size of the product is 8 crore, and average investment during this January to say last 15 months is 6 crore. Okay, that is the average investment that is done in this product, and absolute gain during this period is 50%. It's not the gain that is fascinating. What is fascinating is there's only 2 negative months. One is 2.61, another one is 1.07, and this is very, very minor negative, 0.04%. Again, this is like it is started from 15 January, so the full month is not there. So probably I will take it as 0 or maybe slightly positive, and say 15 out of 15, only 2 months negative, and that too on a close to close basis, only 2.61% drawdown. But on intra-month basis, the drawdown has gone to 13.22%. That has happened right here in May month, and our equity curve peaked in on 6th of April. somewhere here, and see the smoothness of the curve. Okay, that is what the curve is. This is monthly curve, of course, and we peaked around 6th of April here, and then the drawdown happens, and some part recovery of the drawdown has happened. But see April month, okay. Now you're seeing this drawdown, okay. But April we started here, and we went here, and we somewhere ended here. Still from this point to this point, we are still up. So April month, we ended positive 0.42. May month with all the, this is updated as of yesterday, okay. So as of now, as of yesterday also, with this kind of volatility, like we have a huge chunk, a good allocation to long only. So long only probably went to 20-30% drawdown currently. So even after decent allocation to long only, and the kind of gaps that are happening on the opposite side, and we have a very good allocation to even trend following systems. So in spite of that, we're able to hold our fort and manage in positive territory so far. So this is the resilience that is possible if you run enough number of strategies and you diversify enough. Like we are diversified across 100 stocks, and long only we are diversified across, like we track around 800-900 stocks, and we invest in 50 stocks in long only side. And long short futures, we trade around, almost out of 200 stock futures, we trade around 100 stock futures. So this is the kind of, and in options also, for example, options, we are running almost 13-14 different strategies in options, directional as well as non-directional, intraday as well as positional. And uh, this long only is weekend to weekend system, very, very long. And long short futures is like, say, 75 minutes, or maybe 2 hours, or maybe day end. There are certain patterns, and there are mean reverting patterns, there are continuation patterns being traded, So it's a combination of all this. That is the reason why we are able to generate this kind of consistent return. And the equity curve is almost uh, kind of a 45-degree line here, but you will have this kind of drawdowns in between. So currently, like everybody is facing this phase, and we are also facing this phase of drawdown, but it is well within what we have thought as a drawdown. Intramonth drawdown like is 13%, but like we have appetite for around 15-20%, and our hard stop in this product is 20%. If we lose 20% from top, probably we'll review some of the strategies here. Otherwise, we'll run it as it is. So sometimes what happens is when you have backtested a strategy, and it shows a drawdown of 10%, but actually when you do the live trading, the drawdown increases by 10%. Or maybe it goes to 12% or 15%. That is where the doubt starts creeping in. Like people start doubting themselves whether this strategy has lost the edge, or whether it is working, or it is too much crowded. Like currently, for example, this famous 920 straddle is going through drawdown. So now a lot of people will start doubting it, whether 920 straddle is a good idea. So something where some strategy has an edge and it becomes public and it becomes crowded, then people will deploy a lot of capital there. And with the deployment of a lot of capital there, you start losing the edge in the strategy. And the moment you start losing edge, a lot of people will go through drawdown and losses. And the moment you come into drawdown and losses, some people will start kind of uh, start losing the faith in the strategy. They will stop the strategy and they will remove the capital after that. That is where the edge will come back. So as a professional, first of all, when you make test a strategy and make it live, you put a real money on the strategies. You make sure you are doing strategies which has an edge and which is a lasting edge. It's not that it's only in temporary, like backtesting uh, uh, period has to be more than at least 4, 5, 7, 8, 10 years. Wherever data is available more than 10 years, I would go for a backtesting of more than 10 years as well. In some cases, like long only algorithms, I have tested from 1995. So you are talking 27 years of backtest. And when suppose you are trading a market like Dow Jones, you should go as back as possible, 50 years, 60 years, 70 year kind of a drawdown. So there is an argument where people will say like, uh, like 50 years is like people were different and markets were different. And believe me, like over a period of time, over a period of so many decades, human nature has not changed. And human emotions that people go through, hope, fear, greed, they remain the same. That is what creates some sort of a movement in the market. And those movements, if you study past, are you're able to derive some sort of a edge out of those patterns. And if you trade those patterns on a consistent basis, like for example, at Medallion Fund, Jim Simon's average trade size, trade not size, trade duration is 1.5 day. So managing $10 billion with an average duration of the trade is 1.5 day. You can imagine the kind of churning that goes through. So what are they trying to do? They are trying to exploit the small edges that exist in the market and diversify that much so that you do not become the market. You don't start killing yourself. A lot of people in our community, particularly system traders and algorithm traders, they do the back testing and without transaction cost and without slippages, and they find the result fascinating. Then they start trading, and then suddenly they realize your backtest and actual results are not matching at all. And so it's very important that one estimates transaction cost and slippages very, very accurately. And also you have to decide the amount you want to allocate to the strategy. The moment it exceeds a certain optimum level size, then probably you start killing yourself. All these are common sense, and all these are very, very important thing which people miss out. And then they start talking about shelf life and all that. So once you go through all this in detail, a lot of parameters has to be checked, like Sharpe ratio, Sortino ratio, your Kalmar ratio, your standard deviations and everything. And these are the links to what I've written, or in interviews I've given, or what presentation I've made. And you can note down this slide, or maybe as a later on when you actually receive the presentation. And the next, before we go to question answers, I want to show you one thing. I've written an article for Money Control way back in April 2020. Okay, so before I go to the question and answer, I want everybody to understand this and keep in mind, particularly these excerpts from Nassim Nicholas Taleb's book Anti-Fragile. The current environment under which we are living is a black swan in its truest sense. But just as human bonds get stronger when subjected to stress and tension, many things in life benefit from disorder, volatility, and turmoil. So, if we want to be really, really anti-fragile and want to benefit out of the chaos that is currently happening in the financial markets, in crypto space, or maybe technology space, or in the geopolitical scenario, you have to have an anti-fragile way of working. So, in this article, I had clearly demonstrated this slide, and actually I had given the backtested results along with correlations. Okay, so this article also I had given backtested result of Milt, and for the backtesting till 2020, it was showing a return of 24 and drawdown of 0.41. And when I combined it with long short futures, which was showing a return of 21% and a maximum drawdown of 8.6%, the drawdown decreased from 41% to 20%, 21%. And return increased from 24% to 45%. This is the power of combining, and the correlation between LSF and MILT is zero. Okay. So if you go through the journals, international journals and all articles, research articles and all that, you will know that any buy and hold strategy has a zero correlation with long short futures strategy. So you have to find more such strategies where there is zero correlation, and you have to combine so that your return increases. Here, like by combining MILT and LSF, what we have done essentially is we have done a leverage of 2 times. Even if after increasing the leverage, the drawdown has reduced from 41 to 20%, and the return has gone from 24 to 45%. The point again and again, see, at the cost of repetition, I'm saying the key is to have enough number of strategies which are non-correlated or less correlated with each other, and diversify so much that you don't become the market. Your slippages and transaction are cost well within, and since you're diversified so much, your allocation to a single strategy won't be that much. That strategy will make or mar your life. Sometimes the strategy goes through a drawdown or underperformance. You are not kind of forced to stop the strategy. You can actually stick to the strategy and wait for the performance to come back. And uh, with this, I would like to end my presentation on this, and probably Ashokji, we can start with Q&A or after break or whatever you want. And
Sounds good. Ravinder, are you there,
I'm
Ravinder
there,
ji?
sir.
Awesome. Sounds good.
Yeah, I'm there, sir.
Ashokji, fine, everything fine? Anything you want to ask before we start
We'll
Q&A?
trouble you with many questions. We just finish a quick, sponsor talks.
Okay.
Yep. Next slide. Next. Next. Yep. Ravinder, over to you.
Okay. Hi, hello everyone. My name is Ravinder Hundal from Espresso onboarding team. We are Espresso and we are committed to help traders. Espresso is discount broking company under a Sher Khan group of companies. For more details, you can visit our website myespresso.com. Next slide, please. Next one. Next one, please. Next one. Okay, thank you. We are providing best-in-class charting solution for every type of trader and investor. As a trader, you do analysis, so you need on-chart and off-chart indicators. Yes, we have 80 plus studies in bench. We try to provide all advanced tool which will help you out to marking zones, lines, and complete your study. We also have chart compare, so you can compare any stock, any indices, or any contract with anyone. Also, as advanced, we provide percentage, log, and linear chart. You can also place orders from charts. Next slide, please.
Yeah, Vansh.
Next slide, sir.
Yeah.
Sir, next. Okay, this one, right. We have a very unique offer for traders. Pay when you profit. So, as an intraday trader, you don't have to pay brokerage on loss-making trade. We have zero brokerage for delivery trade in cash market. Free auto square off for MIS. We have split order. You can place large quantity order in one order. We have 350 plus cash market script for MIS trading. You can place bracket order for Nifty, Bank Nifty. You can place aftermarket orders, and also you can apply for pre-IPO order. Next slide, please. Yeah, you can customize your screen the way you want. You can add multi-widgets, different screen layout, live IV and easy order placement from bid ask price. Also, you can drag drop strike to bulk order for strategy orders. We are developing more advanced features for option traders. For more details and account opening, you can visit our website myespresso.com. And also you can check out our YouTube channel, Espresso Invest, where we have demo videos for all features. Thank you, sir, and over to you.
Thank you very much, Ravinder. Next slide, please, sir. Okay, here is a quick update on Espresso, and unique offer for all the Super 25 attendees. Please go ahead, open an Espresso account on or before 30th of June. You will get 2 months of brokerage free trading. Okay, wait for the joining link from joining email or Telegram update from us. You will get communication from both Traders Gurukul and Money Control on this, and then you join from that link. Okay, do not go and open the account with a normal link. You might not get that offer. All right, so if require any support, please buzz the support teams, respective support teams. They will be in a position to help you. Next slide, please. Okay, so here is an invitation to every one of you. We have already discussed this before. We are having Traders Conclave at 2022, India's largest retail stock traders residential conclave ever happening in Bengaluru for the first time in the month of September at Hotel Hilton, close to the airport. It's a lovely 3 days program, 8 sessions with championship for everyone, where there will be a real-time competition that goes on with real-time data tracking, and we have 3 champion of the conclave awards to be won and 1 master of the series award to be won. Lot of awards, accolades awaits you. Next slides. Great. So there are series of speakers. One of them is a 200 crores quant fund manager, and one guy is a GAN expert, an Elliott wave expert, a $1 million fund management manager, positional weekly option writer, and also a bunch of straddle players. You know, a lot of experienced people are joining us on board, and look forward for your participation to learn more from them. Next slide, please. Okay, so friends, next slide, please. The ideally an event of this magnitude would officially, organization charge from the 40,000, 50,000, even 75,000. We have kept the price extremely low, and the price is only for the cost of the event. This is a non-profit event that's being planned and run since we are doing it for the first time to now to build the brand of Traders Conclave. Next slide, please. It is charged at 24,999 only. Go ahead, grab the seats, come with your friends, talk for if you want. If you're coming with your friends also, please speak to the support team and ask for additional discounts if you wish to. The idea is to just assemble together, learn together, and celebrate together and participate together. Talk to the conclave manager Fazil, buzz him on Telegram at Traders Conclave. Okay, if you want, you can bring your family also. We will sponsor your kids. Don't worry about that. We'll work out something. All right. Please do come. It will be one of the memorable experiences that you would have. Next slide, please. All right, here is the quiz, the 18th quiz of the series. Who is the founder of Medallion Fund and Bridgewater Associates? Who are the founders of Medallion Fund and Bridgewater Associates? Fill up the blanks, fastest finger first. Okay, next slide, please. Okay, now the winner will get access to the Option Omega and Intrazone events with lifetime recording access, and he will also be eligible to participate in the Man of the Series Super Award with educational goodies worth 1 lakh rupees from Traders Gurukul. Thank you. Next slide, please. All right, the winner of yesterday's question, which is the latest cryptocurrency, crashed to nearly zero. The answer is Terra Luna. If you have answered it as Luna, also it's fine. The first winner is Mr. Purushottam. Congratulations, my friend. I look forward for your participation in the Man of the Series context. All right, so go ahead, shoot your answers for the 18th quiz, and also take the opportunity to participate in the Man of the Series award. Next slide, sir. All right, sounds good. Here is the Q&A session now. Go ahead, shoot your questions to Mr. Rakesh Pujara. Let us trouble him with some interesting questions. So, Rakesh sir,
Yeah.
okay, question by Mr. Chinar Lathia. Do the returns also take into account income tax on all gains over the years? I doubt it's a no.
No. It doesn't take income tax into account, and it's
Correct.
pre fees and pre taxes, of course. And government is always a partner in crime. Always you have to pay your fair share, and so that is why I always show you average annual return and not the compounded return, because compounded return will have to take care of income tax and fees and everything, and that your compounded return will definitely look much lesser.
Okay. Here is one question from one of the participants, Mr. Vijay Malik. So please explain one of these strategies in simple words so that we can benefit out of it.
So see, I would not like to go to strategy detail, but suppose say for example Reliance, okay, you are trading Reliance, and when I say buy and hold, you just simply buy Reliance shares and hold it for say long term. So when Reliance shares becomes from 1,000 to 2,000, your return is 100% in say 4 years. So your average annual return is say approximately say 25. And suppose in between, say Reliance go from 1,000 to 1,500 and then comes back to 1,200 and then goes to 2,000. That those 300 rupees is actually pick to trough. That is what we call it drawdown. And suppose you decide to play both sides of the market, that is long short futures, the strategy I was talking. And your simple rule can be, say, suppose you go long above 50-day moving average and you go short below 50-day moving average, for example. So that will enable you to play both the sides of the market. So when the prices falls from say 2,000 to 1,500, instead of going through the pain of prices going down, probably you will be able to make some return out of it. So one strategy was only buy and hold, that is milt. That was based on some assumption of buying. Suppose you have that assumption also. Suppose you buy when the prices go above 50-day moving average and sell it back. So you come back into cash. That is buy and hold. But suppose you play long short futures, you go short also. So you make money when the thing goes down. So that is an example of a basic buy and hold, milt, and probably long short futures, for example. Not necessarily the parameter I mentioned, I'm using that. It is just a simple illustration of what you can do.
Sounds good. Okay, next question is from Mr. Anant Naik. Is leveraging banned now by exchanges by any chance?
Not at all. Like when I say when I'm using the word leverage, I'm using the leverage inherent in the derivatives market. So when I say leverage inherent, for example, you buy a Reliance future, say 100 shares worth 2,000 rupees, your value is 2 lakh rupees. But to buy 2 lakh rupees in a future market, you generally end up paying 20 to 25 rupees as a margin. So with 25 rupees, you are able to buy 100 rupees worth of stock. So this is 4x of what your capital is. Your capital is 25 rupees. And when you buy the futures worth 1 lakh rupees, for example, you are leveraged 4 times. This is what the leverage is. And suppose you buy, instead of buying Reliance futures, suppose you buy at the money call, and suppose 2,000 rupees call for on a typical beginning of the expiry, say around trading at around 4%, that is 80 rupees, for example. So 80 rupees into say 100, that is 8,000 rupees. So with a 8,000 rupees investment, you are able to buy 2 lakh worth of exposure in Reliance. So that is essentially leverage almost, 20, 25 times. So this is the leverage I'm talking. When you are buying options, you are actually taking a leverage because your exposure is on the underlying. So what is underlying? Underlying is Reliance. What is the price of Reliance? 2,000. What is the lot of Reliance? For example, say 100 shares. So your value of Reliance is of course 2 lakhs, but you buy a call for 80 rupees, and you buy 100 Reliance at 80 rupees call, so you make an investment of 8,000 rupees. So basically, you are able to take exposure in a 2 lakh worth of Reliance with only 8,000 rupees. So that gives you a leverage play. But I would not advise any newcomers or those who do not understand the game to deploy this kind of leverage. So, but yes, exchange do offer this kind of leverage, and this kind of leverages are available in Indian exchanges.
Sounds good. So the next question is, let me pick up some more questions. Okay, sir, what is the kind of slippage considerations you have done for your strategy?
For indices futures, Nifty I take 3,000 rupees per crore. For Bank Nifty, I take generally 4,000 rupees per crore each side. So when I buy, I presume 0.04% slippage into Bank Nifty, including transaction costs. And in options, I generally consider 0.75 to 1% as slippage. When I do option strategies in stock futures, generally I assume a slippage of 10,000 rupees, 0.10% as a slippage, because generally in stock futures market, bid and ask is around 0.07, and that is what slippage that you have to account for. And depending on the kind of strategy we run, depending on the liquidity, depending on the instrument we take, we modify our strategies accordingly. What see, I've traded market for more than 20-25 years, and I understand the actual slippages that happen. So my result has to be near to the backtested result. That is the crux. I cannot live in fool's paradise and just backtest without transaction cost and real life slippage. Suppose I have to buy 1,000 Bank Nifty, and suppose I have to buy 1 lakh Bank Nifty. The slippages are going to be way different than buying 1,000 or maybe buying only 50 Bank Nifty. So when you backtest, you have to take a real life slippage, and you have to actually see what kind of slippage you have. I generally keep a track on a real time basis, on a daily basis. Like in our office, we maintain a slippage report also. So what is my software showing, and what is the slippage I have taken, and what is the slippage actually happened. And suppose there are gaps, we try and fulfill the gaps by revising our backtest, either on the upside or on the downside. But generally, I take more slippage than what actually happens, so that a realistic return figure can be arrived at.
Sounds good. Sir, what is the typical amount that is deployed on a single strategy? I mean, what is the maximum lots that you will punch on a single strategy?
So single strategy, like there is no maximum loss for per trade basis.
No, maximum
What
lot
I
size.
do,
And we are talking about lot size.
lot size. Okay, lot size is for a stock future, it is minimum one lot, of course, because suppose I'm trading 50-60 stocks, and if I trade one lot, probably you need a margin of 1.5 to 2 crore. Okay, on a Nifty, you can even have one lot, but generally uh, between 9 strategies, if I have spreaded my 8 crores, so average being say 0.75 lakhs for each strategy. So suppose it's in indices future, then you end up buying say around 1,000 Bank Nifty or maybe 1,500 Nifty and all that stuff. So these are the kind of lot size, and uh, suppose I'm trading 50 stocks, then probably one lot each. So that gives me an exposure of say around 4 crore and a margin of around 1 crore and all that. So this is how we devise lot size and allocations.
Sounds good. Sir, one question by Mr. Shankar. Any example for correlation between strategies? Like zero, any example for zero correlation?
So you take a return of say Nifty long only. Say for example, on a daily basis you arrive at return, or on a monthly basis you arrive at return, and compare it with any long short future strategy. Okay, and you run a correlation on an Excel sheet, and more often than not, if I show you the example of one sec, I'll go back. The strategy 8 is a long only strategy. Okay. And all other strategies are long short and options and other strategies. Okay. This strategy 8 is my long only strategy called MILT. See the correlation with every other strategy. It's near to zero. And in some cases negative. See the correlation here, 0.08. So if you compare any long only strategy with any long short strategies, your correlation will be near to zero and maybe minor negative. So this is how you devise, and within even long short you can have low correlation strategy as well. For example, strategy 3 with versus strategy 2, it's very low correlated. 0.1 is not a high correlation, and in some cases like we have say 0.18, 0.19, this kind of 0.08, for example. The strategy 5 has a correlation of 0.0 with strategy 2. So when you run strategy 2 with strategy 5, your drawdown is likely to reduce a lot. And combined with strategy 8, your drawdown will further reduce. This is how you sensibly do correlation test and combine strategies and decide allocations. I hope it has cleared the point.
Sounds good. Sir, when you look at the master mega strategy, how many set of micro strategies are involved? The
Like
mega
for example,
information.
one sec, I'll just show you this
So,
strategy.
yeah.
This strategy, infinity indices.
Okay.
This is actually I have mentioned it as one strategy, but
Okay.
it has got 125 strategy within this one strategy.
Oh my God. Okay.
So this is the level of diversification that is required to achieve this kind of ratios.
Understood.
So this
So
single
when you look
strategy
at
track. Yeah,
when you look
tell
at
me.
the big 8 crore strategy, so how many strategies are there inside it? It will be much bigger.
Much bigger, much bigger, much bigger. Like for example, our options suite has around 10 to 12 strategies. Our indices suite has around 125 strategies, and there can be single strategy like LSF is a single strategy, long only is a single strategy. So all in all, if you total up number of setups that we track is it's around 140 across all strategies, and if you track the instrument that we are trading, it is upward of 155 instruments. Like when I say instrument, when I trade a strangle, it's an instrument. When I trade a straddle, it's an instrument. When I trade a Reliance, it's an instrument. When I trade Axis Bank, it's an instrument. So around 150 instruments, around 150 setups. So if you do the permutation combination, it's all mind-boggling. But together
22,500.
it works. Together it works as a fine ecosystems, and I showed you the result, right? This is the results. This is the results because of the diversification into strategies, because of the diversification in the instrument, and this is because of this kind of correlation that we run. This is the kind of correlation that we run. Otherwise, it's not possible.
Okay. Sounds good. Sir, a question by Vignesh Pranav. What is the technology that you guys are using for punching these many strategies together as a whole? What technology?
So currently, we are using semi-automated algorithms where all our orders are through a batch file, and we're in the process of completely automation because at many level complete automation is falls within some gray area. So we have not completely automated, and we are semi-automated where we generate batch files using our codes and we upload those batch files, and our dealers sensibly execute those trades. So all the decisions that buy and sell decisions that happens, they are all automated, but all the execution is semi-automated. So, and we are in the process of completely automation once the regulatory clarity comes about complete automation.
Sounds good. Sounds good. So do you use anything like Symphony what robot? It's all in-house technology that you're using?
This is all we have used all in-house. So we have started just the process of automating using Symphony and Alpha Fox and U-Trade and all that. We have just started this project of complete automation, and it's 3 to 6 months away, where we'll be using Symphony and U-Trade and other API that is available for automation.
Sounds good. Another question by Mr. Naresh Kumar. Is it do you can connect to any brokers? How do you connect? Through APIs or something?
Yeah, we are like a broker neutral, so we are okay with any broker, and we can integrate with them. There is not an issue.
Fantastic. So let me pick up some more questions. Sir, how do you calculate slippages for your cash market game?
Cash market, I'm taking a slippage of 1% on buy side and 1% on sell side. So that is what, and we are able to do reasonably well with that. And generally, we slice our order in the last 30 minutes. So whatever we buy or whatever we sell, uh, we end up buying it average. And sometimes when there is circuit up or a circuit down, and some more slippages happen, but sometimes slippages happen on a positive side as well. But if you notice my long only algorithm, I'll just show you my long only algorithm once. The statistics of that algorithm is where is the statistics? Yeah, this mint. Okay, no, not this one. This 27% one, right? See the gain. Average gain is 182%, and see the average loss 19%. See the number of trades, 600 trades in last 10 years. Okay, so you're talking 60 trades a year. So it's not a very, very high churning strategy, and
Hardly
slippage,
one
it is not very,
order per week.
yeah. So it's not a very slippage sensitive algorithm. Still, we have taken a slippage of 1% on buy side and 1% on sell side. Even if you make 1% to 3%, it's not going to move a needle because number of trades are very
Correct.
less, and average profit per trade is very, very high. Average loss per trade is very, very low. Of course, success ratio is very less. 34% of the time we have trade in our favor. Otherwise, 65% of the time we book losses. But we book very less loss, let's say 20%. But when we actually there is a winner, we ride it. But there is a system of pyramiding here as well. We pyramid winners. So that is why we are able to generate this kind of average profit percentage per winning trade.
Fair enough. Okay, an interesting question from Bala. Sir, can we connect to your algorithms through Espresso?
Espresso, not currently, but we can explore. We can explore. You can get in touch with Espresso guys, and probably we can try and work something out.
Okay. Sounds good. All right, sir, maybe you can move on to the last slide.
Yeah, man.
Okay, so sounds good. With this, we come to the end of the session. Next slide, sir. Dear Mr. Rakesh Pujara, thanks for your insightful session. On behalf of the participants of Super 25 Edition 3, the Money Control Pro team, the Espresso team, and all the extended family members of Traders Gurukul, we extend our sincere thanks for joining this event and sharing your knowledge to every one of us. Thank you very much once again, sir.
Thank you so much, Ashokji. Thanks, Fazil. Thanks all the participants, and it was a great session, and I enjoyed it.
So friends, that's the story for today. I hope every one of you enjoyed the session. I will see you all on Monday with yet another interesting session. As you all know, tomorrow is Sunday and there will not be any session. I will see you all again on Monday with one more interesting session. Until then, signing off, Ashok Devanapriya from Traders Gurukul. Good night.
Thank you all. Thank you all. Good night.